G'day guys, Nathan here from Galloway. Today, we're going to deep dive into the alarming surge into home loan repayments as record low fixed rates and provide practical strategies for weathering the financial storm. As we see a massive financial challenge looming for millions of Australian households with home loans that were fixed in. The issue arises from the expiration of roughly around 800,000 fixed rate mortgages this year and another 450,000 set to end in 2024. These homeowners who benefited from record low interest rates during the pandemic are about to transition to a variable home loan. And this is coming off the back where we've seen the steepest rate hike in the last 12 months and the most drastic increase ever recorded. Now, the implication of these fixed rates ending and moving to a higher variable rate is significant. For example, on a $500,000 mortgage, the estimated increase from ultra low fixed rates to current variable rates would see an increase on the monthly expense for repayment of $1,200. This $1,200 increase brings a $500,000 mortgage to $3,000 per month. And this could further be heightened if the Reserve Bank of Australia continues to increase the cash rate in the coming months. This phenomenon will affect millions of people who fixed in their loans during the pandemic when fixed rates were ultra low. As a result, many homeowners are finding themselves needing to source thousands of dollars extra each month to meet their mortgage repayments once their fixed rates end. And at the heart of the problem is simple but significant. When the fixed rate loans expire, homeowners will be facing a substantial jump in their monthly repayment. A mid-2019 report by central bank economists found that fixed rate mortgages only made up about 15% of all lending for housing. But during the pandemic and the Reserve Bank providing ultra-low funding facilities to banks, ultra-low fixed rates became attractive. And by the end of 2021, nearly half of all loans were fixed-rate mortgages. Now, this surge in fixed-rate home loans is about to hit a wall, the so-called mortgage cliff, as they expire and roll on to variable rates at around that 6% mark compared to their roughly 2% rate that they've previously been on. And if you find value in this video, please consider hitting that subscribe button, as it does really help out the channel. And a big thank you to all our subscribers for your support. Inspires us to create more content we hope you enjoy. The Reserve Bank of Australia highlights that approximately 40% of all fixed rate mortgages were active in early 2022 are now due to run out by the end of 2023. An additional 20% will expire at the end of 2024. That's about 590,000 loan accounts in 2022, swelling to 880,000 in 2023, and then 450,000 in 2024. Despite the temporary halt in the increase of the cash rate this month, the Reserve Bank might have intent to increase the cash rate in the coming months. Many households are likely suffering sleepless nights, so we've got some practical tips that you can do today that'll help with your situation. The first is to negotiate your current rate with your lender. Don't just watch your repayments increase. Instead, do a little bit of research, talk with a mortgage broker like ourselves, and understand what is available in the market. If your loyalty and good credit history aren't enough to earn you a significant reduction, consider pushing harder or even switching lenders. Your best leverage points are if you've been with your lender for a long term, you've had consistent repayments, stable employment, you have a good amount of equity, great credit score, and have been occupying in the property as an owner-occupier. So talk with your lender, see if you can get your rate down, even look on the bank's website. A lot of the times they'll offer new customers better rates than what you're getting. So give them a call, tell them what you've seen on their website and get that rate down. Or give us a call, we can have a chat, talk to you about the market, let you know what's available. The second, if they don't play ball, is consider refinancing your loan. If your current bank refuses to lower your interest rate or provides you with a discount that's insufficient, switching your loan to another lender can be a good option. In a lot of cases, you can get cash back, so the cost of moving is nullified by the fact that you get an incentive to move your loan. And you do need to be aware that there can be some costs associated with moving, so you do need to weigh that up with the potential benefits. But in the case where you're getting a cash back, that will mean that all of your costs are covered and it will make sense from day one. Also, it's wise to use a mortgage broker like ourselves where we can guide you through the process and help you with any incentives like cashbacks or any other offers available to you in the market by looking at a wide range of lenders. The third is to seek assistance if you're struggling. If you're currently having trouble meeting your monthly repayments, reach out with your lender and their hardship team. They can offer you options like freezing your mortgage repayments, a cheaper home loan, or even extending the loan term out. Sometimes they'll even offer interest-only terms. Now, all of these options are short-term solutions and aren't going to be great for paying off the loan in the long term, but often it can get you back on track, especially if you're having a temporary reduction in hours, or you're struggling to make ends meet due to cost of living increases, that can sometimes help you bridge the gap and get you back on track. It's important to reach out earlier to ensure you have more options and you avoid damaging your credit score. The third is to review and adjust your budget. With mortgage costs rising, finding extra money by revisiting your budget and cutting back on non-essential expenses is another strategy you can use. And this is where using a budgeting app can help track your spending and identify areas you can potentially save. If necessary, it might even be worth finding a side hustle for extra income. And if you are in a really difficult situation, it's worth consulting with a financial counselor. If rising mortgage rates have become a part of a larger financial issue and you're sinking in debt, reach out with a financial counselor. The National Debt Helpline in Australia offers free, confidential, and independent advice from trained financial counselors who can guide you through options and help you understand your rights. During high interest periods like we are at the moment, it's essential to strategize. While interest rates are a monetary tool used by the Reserve Bank of Australia to cool the economy, these rates are unlikely to remain elevated for long. Historically, peak interest rate levels have lasted from 4 to 16 months, averaging at 10 months. Consider higher household debt, and the already high standard variable rate is unlikely to see that peak interest rates will persist longer than 6 to 12 months. One coping strategy for higher interest rates is using financial buffers, such as cash savings in an offset account, which might have been built out during the low interest rate periods. Reducing discretionary spending on things like travel, holidays, and dining, etc., can also help manage with the inflationary pressures we've seen at the moment. And this can be done by allocating a specific amount for discretionary expenses, paid from a dedicated account, which will enhance spending awareness without the need to track everything. Remember to like, share, and subscribe to stay informed with the latest finance and property news. Additionally, it might be considered exploring increased income opportunities, like a new role, working more hours, retraining, or finding a second job. With unemployment levels at record lows, employees might have an opportunity to negotiate a fair remuneration increase. Large leave balances can also be cashed out if required, and something to think about. Effective financial management can include eliminating expensive repayments and refinancing or resetting loan terms. Using savings to pay off things like HECS debts or personal loans can improve regular cash flow, and even refinancing to reduce monthly repayments can help. For instance, if you have $1 million loan, extending the loan term from a 20-year term, which it might be on at the moment, to a 30-year term might reduce your monthly repayment by $1,000. Now, obviously, you are going to be paying the loan over a longer period of time, so you do need to think about that, but it might just well help you out in the short term, particularly if you are struggling with high interest rates. And like we talked earlier, peak interest rates might not be a thing that stays for too long based on what we've seen in the past, so it could be something that could get you through the next 6 to 12 months. Here at Hunter Galloway, we're a mortgage broker and deal with people Australia-wide and can assist with any refinancing needs that you might have. Simply call us on 1300 088 065 or visit our website huntergalloway.com.au. Guys, as always, thanks for watching and we'll see you next time.